while high yield stocks have had quite a recovery really since the beginning of July, there's one sector in the high yield space that has gotten left behind pretty well that kind of surprised me that it has, and that's midstream. They're very similar to utilities and REITs in the sense that they have long duration, contracted or regulated cash flows. They pay high dividends or distributions depending on whether it's an MLP or a C Corp. But they're these high yield instruments that are very defensive in nature. They're bond proxy-like. And so with the pivot to rate cuts and more concerns about economic weakness, I thought that midstream, they should have experienced the recovery that infrastructure and REITs had. Now, fortunately for me, midstream had gotten pretty richly priced relative to these other stocks with their very strong performance since the COVID crash. And so I had weighted my portfolio more heavily towards utilities, infrastructure, real estate, although I still had a strong core position in midstream. And so I've been able to participate a lot in the upside, but recently I've been rotating more and more of it back towards midstream because of this disconnect that I see. And it's partly explainable. Energy prices have fallen some. The energy sector, as depicted by, say, an ETF like XLE, has performed fairly weakly in recent months, and midstream, by association with the energy sector, even though its underlying cash flows are largely agnostic to short-term movements in energy prices, has gotten thrown out as a baby with the bathwater, so to speak, by association. So I think this is a valuation disconnect that creates a lot of opportunity. And there's one midstream in particular that I think presents a compelling value opportunity right now. In today's video, I'm going to discuss it more and how the more underperforms, the more I buy. Before I get into the video, though, if you could please give it a like, that'd greatly help in its distribution. I'd be really appreciative. Thank you so much. Okay, so what is this midstream business that I really like? It's Enterprise Products Partners. Anyone who has watched my videos since I started this channel or reads me regularly on Seeking Alpha knows that I like Enterprise Products Partners. But what may be interesting to many is that despite its long-term track record of delivering market-crushing returns, growing its distribution for 25 plus consecutive years, including at a mid-single digits CAGR in recent years, and is likely to continue that for the foreseeable future, has so many other strengths. Despite all that, over the past half decade, the last 5 years, its unit price has practically gone nowhere. And that's pretty amazing because they have grown their EBITDA significantly over that period of time. They've grown their distributable cash flow per unit. They've grown their distribution per unit, all those things quite a bit over that period of time. They've brought their leverage ratio down to one of the best in the sector at 3.0 times. They've continued to grow and further diversify their business, increase the asset quality and stability of the overall business through skillful targeted asset purchases and investments in organic growth projects. They've earned a credit rating upgrade to the best in the sector at A-. All that has happened during that time, and they even proved their mettle during COVID by being one of the midstream companies that did not have to cut their distribution. In fact, they continued to grow it through the crash, whereas peers like Energy Transfer, Plains All American Pipeline, and some others actually slashed their distributions quite steeply, in fact, in the face of COVID headwinds. So all that, yet EPD has been rewarded with basically a flat unit price over that period of time. Now, of course, they've paid out a hefty distribution over that period, so they have generated positive returns for investors. But surely their intrinsic value is much greater today than it was then. And I completely agree. I think this is an incredible opportunity for investors. It yields over 7% right now. The distribution is covered by 1.7 times with the distributable cash flow. That distributable cash flow per unit should grow at least in line with what they're growing the distribution at, and it's about a 5% CAGR for the foreseeable future. And so they're going to continue to retain lots and lots of cash flow, which they're using to fully fund their growth projects, which are quite robust in nature over the next few years. And once those come online, they're going to have a step size increase in EBITDA, while also having a step size decrease in capital expenditures. And what is that going to mean for the company? Well, it's going to mean, first of all, their distributable cash flow per unit is going to jump higher because they're getting all that extra cash flow. Their leverage is going to drop significantly because they got the EBITDA up, and leverage is just net debt to EBITDA. So that's going to cause a massive increase in that. But perhaps most importantly of all, their free cash flow is going to soar because in addition to all that extra cash flow coming in, they're not laying out nearly as much for growth projects. So they're going to have this huge bundle of free cash flow plus excess capacity on their balance sheet due to their leverage ratio shrinking from all that EBITDA coming online. That's going to give them a lot of capital to either make a major acquisition or a series of acquisitions, which would also transform the business through potentially enhanced diversification, additional growth prospects moving forward, safer profile due to increased diversification, maybe even a credit upgrade that would come from the lower leverage profile, and or if they made a major acquisition, that would further strengthen the business model. And it also simply gives them enormous capacity to create intrinsic value for unit holders, whether through a major buyback, a major distribution, special distribution, accelerated distribution growth, or some combination of all those with an acquisition or whatever you have. Management has indicated that they're going to look at all those options when the time comes to see what is most advantageous to unit holders. And the thing is, I really like EPD is I trust them. Their track record is exceptional over the long term of total returns, consistent distribution growth. Management and other insiders own about a third of the equity. They've grown the distribution consistently, allocated capital effectively with 10% or greater returns on invested capital consistently through energy and macroeconomic cycles. And so they are arguably the best capital allocators in the midstream space. They've done a great job. I trust them completely to represent my interests well as a unit holder. And so this is really exciting stuff. I think the market is completely missing it over some short-term pessimism about if the economy goes into recession, energy prices might drop. But again, that will hardly hurt EPD as it's proven in the past. And so I think, especially if you want really high-rated businesses in terms of their credit rating, their balance sheet strength, the business model strength, the distribution safety and dependability, you really can't beat EPD right now. There are many other midstreams that I like. I think MPLX is another great one. Western Midstream is a great one. I think Energy Transfer is a great one. And Plains All Americans, those have come a long way since their distribution cuts in 2020. And there's some great ones on the C Corporation side as well. But again, on a risk-adjusted basis, if you just really want quality and looking at the near-term and medium-term outlook for these companies and what catalysts they could have, it's really, again, hard for me to not just say, hey, EPD is where it's at. And so that's why the more it underperforms, the more happy I am, because it means I can buy more and more and more at a discounted valuation. So again, hopefully this video was helpful to you. If it was, please subscribe to my channel. I'd greatly appreciate it. And let me know in the comments below what you think of EPD as well as other midstreams out there. Of course, as always, note that EPD issues a K1 tax form, which makes it unsuitable for some investors. But if you want exposure to EPD and don't want to deal with the K1, you can always buy a ETF like AMLP or MLPA that give you a large exposure to EPD along with some other MLPs that I like as well right now, but they don't make you deal with the K1s that give you the 1099. Of course, you pay them an expense ratio in exchange for that, and you also have some double taxation potential issues, especially if you hold it outside of a retirement account. But I still think those are good places to allocate capital right now, especially if you don't want to deal with the K1. Thank you very much. See you next time.